Welcome to the program. My name is Marty Shenkman. I'm joined by my friend and colleague, Alan Gassman. And what we're going to do is talk about the Practical Planner. It's a firm newsletter I send out quarterly, and we just did the first quarter of 2023. And it was actually Alan's idea, so credit to him. So why don't we make webinars out of this? And he's going to offer different opinions and insights on anything we say. He will probably disagree with everything I say. So it'll mix it up and make it more interesting than whatever you might have read. So if you've read the newsletter and memorized it, which I'm sure you haven't, this will still all be new. Couple of quick housekeeping comments. The PowerPoint's available for download on the webinar console. When the program is done, we'll post a recording of it to Shenkman Law under webinars. There's a growing library of about 150 or more webinars there, and I'm sure, Alan, you'll have it on your firm's website as well, correct?
That's right.
And we don't give CLE or CPE, but you will be sent, you may be sent a certificate for the program. General disclaimer, this comments are for educational purposes only. Obviously consult with appropriate professionals before taking any guidance action. So the first topic that we're going to talk about is the Corporate Transparency Act. And it's going to frustrate and anger people. It's going to be a real headache for not only clients, business owners that are affected, anyone that's done an estate or asset protection plan, has multiple entities, if not even more, that are all going to have to file reports. It's new. This has never happened before. And it's going to be not only a significant administrative burden, but I think it's going to really bother people. And it bothers me in terms of just more government disclosures that government has on record. And, you know, it's I don't want to say anything political, but it certainly gets worrisome how confidential government data is not always kept so confidential. And now they're going to have more information from us and you on all of our entities. Alan, do you want to make any general comments about the CTA before we start talking about it?
No, I agree with your concerns. I'm glad that it doesn't apply to trusts. It applies to basically any entity that you would file with a Secretary of State. But it will be a lot of paperwork, and it surprises me that they said the average cost of a filing will only be $85.
Come on.
I know. I can't answer my phone or answer an email for $85. So it's going to be a challenge for a lot of accountants and lawyers, I think.
Listen, Alan spilled the beans. I think I have it in a later slide, but let me just say it now. There is no reporting at present for trusts, but the Biden administration's Green Book does have really extensive provisions that are actually even more invasive, I think that's the right word, than the Corporate Transparency Act is for entities as to trusts. Now, I don't think it's very likely that much, if anything, will be passed from the Biden Green Book. That being said, you can never predict what might happen in Congress with, you know, backroom deals that are made, like with the deficit budget debt ceiling negotiations. Who knows what will get passed? But I think, and this is really important, is the big picture. The America has not had the kind of reporting that many other developed countries have had for years. And I think we're kind of playing catch up, and we are going to start moving in that direction. The Corporate Transparency Act is one of them. And this was a bipartisan piece of legislation. So we may very well find that all these detailed disclosures on trusts may also come into play. So I think the bottom line is we all need to just come to terms with this, that the government is going to get more reporting. And this will, it's not only the cost or the invasive feeling of it, but in some cases, this could really have significant ramifications. You know, I'm concerned for people that are worried about personal safety, you know, that as the disclosures grow and more people may get access to it, what might that mean to compromise people's confidentiality to whatever extent you still have any? So let's talk about the Corporate Transparency Act to give you a better idea, because effective January 1 next year, all new entities formed will have to do it. So it requires privately held entities to report pretty detailed information to the Treasury Department. And supposedly they say that only appropriate government agencies will have access to this information. I'm concerned what that may mean in practice and who may have access to it. I'm also concerned, and Alan, I didn't write about this in the slides, but if you're going through a divorce or a lawsuit, plaintiff's counsel is coming after you. Now that these filings exist, can somebody ask for them as as part of the disclosures in a court proceeding?
I would think so.
That's bad.
Returns.
And why is this any different? So again, if you have an LLC that you set up to hold investments, to own a rental property, to own your law practice, or an S corp, or a LLC or S corporation to hold securities that you have for a second layer asset protection, and that's then fractionalized and owned by, all those are covered. All those are covered. You have an LLC set up to own a vacation home, it's going to probably be covered. So it's pretty broad. And I think that the reporting will feel invasive. It's going to cover a lot of entities, but it goes further. In the second bullet point on slide 6, it not just applies to the entities, but to the beneficial owners of the entities. And wait till you hear how that they define that. Very, very broad. It's not just what you would consider an owner. So it's going to be costly. It's going to take time. As Alan just pointed out, this may now be documents that if you're involved in a lawsuit or divorce or other actions, somebody may ask for because you're required to file it. And I think Alan's analogies make sense. Why is it any different than an income tax return? They ask for those in cases pretty routinely. So why not that? Hang on one second. It tries to create a comprehensive, searchable national database of information on entities. That's worrisome in itself. The objective is to pierce through the entities, the form of the entity, and identify the people behind the entity. So if you have an entity that's owned by trusts, they may pierce through that. Who are the owners? If you feel that you've used an entity to own real estate, you're going to have to disclose your name as the owner of that entity and your personal home address, not a PO box. Many of us are accustomed to using our PO box or our business mailing address for all sorts of things because we don't really feel comfortable. I'm saying we because I'm including myself in this, and probably Alan as well. We don't feel comfortable having our home address on lots of tax and governmental filings, but you're going to have to use your home address, not a PO box. So privacy is disappearing. Why are they doing all this? The government is just like governments in other developed countries, trying to get information in order to prevent the use of entities for tax evasion, money laundering, and other financial crimes. And they're trying to get the US on par with these other entities. So the principals and owners of all the different types of entities, limited liability companies, limited partnerships, S corporations, other closely held entities will all be affected. If you have, for example, and it's very common in real estate, let's say you own 20 or 30 rental properties, common to have a separate LLC for each one of those rental properties to prevent a domino effect. If a tenant has a suit on one property, the other properties are protected in LLCs. Every one of those entities may have to report. For some clients, this is going to be a pretty significant undertaking. We routinely create LLCs and layers of LLCs for asset protection, estate planning, for a variety of reasons. Every one of those will now be subject to a reporting requirement. Alan, if I have a disregarded LLC that I own 100% of, so it's not filing a tax return, do I have to file, but I don't file a tax return? Do I have to file under the CTA?
Absolutely. Absolutely. That's what they're after. They don't want anybody to be able to hide assets. So I think they figure if citizens know that they have to report the entity, they're less likely to hide things in the entity.
So the bottom line is everything's affected. And I know a lot of people, that's why I asked the question to Alan now, if you have a disregarded entity like an LLC that you own 100% of, so it doesn't file a tax return, or a grant or trust owns it, doesn't exempt it. And I gave the example before, but lots of people have vacation homes held in LLCs. It's a great way to have rules and regulations about how family members use the home. It's a great way to have it held by a trust in a different jurisdiction. People set up LLCs to hold artwork or other property for a variety of reasons, all going to be tagged by this legislation. And the exceptions, Alan, do you want to talk about some of the exceptions at all?
The exceptions don't apply to anyone who's watching this webinar.
That sums it up. That sums it up. That's funny.
But I will say, Marty, I'll be able to buy a new house or something from all the revenue, because when we go and we do our annual reports for all the clients that we do annual reports for, here's another piece of paper with another 4 pieces of information, another $100 to $150 per entity per year. And the clients will say, gosh darn it, that darn government, they made us pay Alan or made us pay our CPA another 100, 150 a year. But what I like about it, Marty, is the clients who would say, I don't want to report this. I don't want anyone to know. Actually, I'm hiding money in this LLC. Well, they don't have to be my clients anymore. And that's okay with me. I personally don't mind that the IRS and some federal agency know all about me, because I figure if they want to know all about me, they're going to know all about me anyway. But they probably can't. First of all, this is the U.S. government, so they probably won't even be able to use it themselves for the first 5 years. It probably won't even work.
So, a couple of comments. I don't think it's going to be $150. It may be after the first one's done, so you have all the information. But it's going to take some time. And we're going to talk before we get through this about some of the things you may want to start doing right now. But here's the bottom of slide 10 is where, oh, and by the way, another comment, Alan mentioned lawyers filing versus CPAs. I kind of, it sounds like a simple kind of return that CPAs would file, but CPAs don't often have all the entity documentation. They may have nothing on their radar at all if it's a disregarded entity. They may not understand or have the details of the trusts and various layers of entities involved in the ownership of various entities. I kind of have a feeling that a lot of this may end up on the lawyer's plate more than the accountant's plate. Alan, any thoughts on that?
I will feel more comfortable doing them ourselves for the disregarded LLCs, because the CPAs, like you say, they just, there would be too many mistakes made because they don't have the direct information. They'll just ask they'll ask the client will give them the wrong information, and then it'll be done wrong inadvertently. Whereas we have the information, it's in our file. It takes a secretary 9 minutes to look it up, and that's just a fact of life.
Look at the bottom of page 10. So when I first described this, I used the language that they use, that owners, but they use beneficial owners. What's a beneficial owner? That is the person controlling the entity. The government, through this reporting requirement, is looking to see who really is controlling an entity. And it's not just necessarily the nominal owner, it's who's actually controlling it. And in addition to disclosing your home address, the beneficial owner is going to have to provide a copy of their passport or driver's license. So this is pretty invasive. That's far more than goes on a tax return typically. Now, here's one of the things that really worries me is what happens when information changes. Alan, you want to chat about that a little bit?
Go ahead and tell us.
So if you have a change in information, that has to be reported within 30 days. So let's say the beneficial owner, and we're going to talk more about that in a minute, changes their home address. Within 30 days of that address change, you're going to have to file a report. Now, how are you going to even know that? And again, this is such a new concept. Will people even know who to tell? Like, why would you even think that if a co-owner of an entity, a manager of an entity, and we're going to come to that, changes the home address, that you now have a filing due within 30 days. And there's pretty significant penalties for all this. What we may have to see, and this is where Alan's $150 for sure will go out the window, is we may start finding that for new entities, I could see, and I haven't really drafted language, I don't know if you've thought about it, Alan, yet, but we're going to start to see probably representations or acknowledgments in like an operating agreement for an LLC, a shareholders agreement for a corporation, that I agree as a shareholder that if I change my home address or any other fact that's reported under the Corporate Transparency Act, I will notify whether it's the government directly, the entity if it has to do the filing, et cetera, within 20 days, because the filing has to be done within 10 days. We're going to start to see more of that. We may then want to see entity agreements amended for old entities to incorporate the language that we start to develop as lawyers to deal with all this, because you want everyone to be responsible. And not only responsible, the first step is they have to know about it in order to be responsible for it. Alan, comments, thoughts?
This 30-day thing, I'm expecting that the political winds will blow in Washington, D.C. If they don't push this whole law off a year or two, I think that this one will change.
30 days is not reasonable.
It's completely unreasonable. It should just be that you would notify them the following year. They don't need to know that soon. That's crazy.
Yeah. And that would make a lot more sense. And then when you do your annual tax return or annual report to the state for an entity, you pick it up then. That would make a lot of sense and be a lot easier. So ownership is very broad. Listen to how they define it on the bottom of 12. Any type of equity interest, profits interest, convertible instruments, warrants, options, puts, calls, or any other entity interest. And it can be controlled through joint ownership, through a trust agreement, indirect arrangements, et cetera. The bottom line is, it seems like virtually anything and everything is going to be captured within that. And that's important, Alan, because it sounds like to me that if you have some kind of like option on an interest in an entity, now you have to report. You're not the owner, you only have an option to get it. You're now pulled into this too.
Well, I mean, they have to do that so that people don't do silly things to avoid reporting.
Correct. But it's a broad net, and a lot of it's not intuitive. So I think one of the initial challenges of all this is because it's so different than things that we're used to doing, like a tax return, that people are going to have to get accustomed to it. Now it gets worse. I feel like late night TV, there's more. So if you're not an owner, but you exercise the authority, which this is the language right out of the law, the senior officer of the entity might hold, then you also may have to report. What does that mean? Could be a chief financial officer, general counsel. A trust protector may have to report. If a trust owns an entity and the trust protector has certain powers, or the investment trustee of a trust has certain powers over the entity, they may have to report. Again, keep in mind that the goal of the Corporate Transparency Act is to catch all of this stuff. The act generally applies beginning January 1, 2024, next year. So for new entities formed after January 1, 24, they want a filing done within 30 days of the creation of the entity. And I agree with Alan, 30 days is just too tight of a time period. We're going to all, in the legal and accounting and tax professions, going to have to become accustomed to anytime an entity is formed, a report's going to have to probably be generated as part of the package of creating the entity so that 30-day deadline is not missed. And I agree with Alan. I don't know why they made such short deadlines that really don't give you much time. So let me give you my suggestions, and I'll see if Alan has any suggestions. I think the first challenge of the Corporate Transparency Act is just identifying all the entities. I've never kept records. Maybe Alan is smarter. I know he's better looking, but maybe he's smarter than me too. I've never really kept records of client entities in a fashion that will facilitate identifying who has to file and what they may have to file. It's just never been done that way. So we kind of have to create new records from scratch to identify these entities. Another thing, if I have a client that has co-counsel in Florida, maybe it's Alan, he may have set up an entity. I may not know about it. Alan may not know about all the entities I set up, even if it's a shared client. So you're going to have to start, and I think you should really start now, if you're a professional advisor, reaching out to clients. And that's why I wrote an article in our newsletter, so it went to everybody. But reaching out to clients saying, let's start getting lists together of every entity you have any interest in. Now, a starting point may be get the accountant for the client to list every entity they file a return for, see if any of the limited exceptions may apply for like an active business or regulated company like a bank, And then you have a list of many of the companies, but that's not enough because, as Alan and I discussed, a single member disregarded entity is not going to be on the radar of the accountant because they don't have a return to file necessarily. The lawyers that set up the entities have to get involved. So I think you need various advisors and the client themselves. If you're a client and not an advisor, I think you got to be responsible and get involved in this, because until we get a list together, we, meaning you, the client, the attorney, the accountant, until everyone collectively gets a list of every entity you have to file for, we don't know that we've got it covered. And the penalties are pretty severe. The next thing I think is to start to identify all the owners and then expand that list to all the people that may have control over the entity. And then you have to get the identifying information to make sure that you have what you need to file. So I think we all have to kind of start getting started now on this. And I'm not really hearing from anybody that they're really doing it yet. Alan?
Well, we have until January 1st, 2025 for entities that are now existing.
Right.
I think Congress is going to push this thing off, but I completely agree. As estate planners, though, Marty, shouldn't we have a chart or a knowledge on each client of every entity and how it's owned? I mean, that's part of putting together a good estate plan. That's part of putting together a good financial statement. I mean, this just helps us with that aspiration. It gives us a good reason to tell clients it's time to update their chart, time to make sure their planning's up to date so we
Yeah,
can comply with law too.
listen, I don't feel that most clients come back nearly often enough. I recommend annual reviews. This is another reason you need it. I find that oftentimes the other advisors for a particular client, the various advisors, let me speak generically, don't really collaborate. If I set up something new for a client, I try to inform the accountant and the corporate counsel, and I'm not sure they do it back. And some clients don't want you informing or speaking to the other advisors. I'm just concerned that it's going to take a while for the first year's filings to identify all the entities. What about shelf entities? Do you have to file for a shelf entity? I think you do. Shelf entity, why don't you explain what that is real quick, and then we'll go on to our next topic.
Well, that's when I form 10 LLCs, and then as soon as a client needs one, I assign the LLC to them, so they don't have to wait for me to form it. Of course, they're rare now, more rare now, because the Secretaries of State allow electronic filing for most people. Marty, the other thing I'll mention is if you have a client that wants limited liability like an LLC, but doesn't want to have to do this filing, remember that the Uniform Trust Code basically says that when you have an irrevocable trust that's doing something, the trustee and the beneficiaries are not liable for negligence or inappropriate conduct unless they are negligent or engage in inappropriate conduct. So I do have clients where, for example, spouse one puts a rental house into a trust. Spouse two is the beneficiary, is the trustee, the children are beneficiaries. Someone breaks their neck in the house, they can only go after people who were negligent or engaged in inappropriate conduct. The trust can be disregarded for income tax purposes and will not have to file under CTA.
Anyhow, this is a big sea change in what we do. In the end, it's not going to be a big deal, but the penalties are significant, and I encourage everyone to start giving thought to it. And I do think it's going to take some time to start getting this information together, and I encourage everyone to start sooner than later. Because don't forget one of the things that's going to happen. In 2024, in the beginning of the year, if this is not deferred, as Alan, I don't know if it was a prediction or just a wish and hope, if Congress doesn't defer these rules, you know, everybody in the legal and accounting profession and some of the other allied professions is going to be consumed with just grappling with dealing with this for new entities being formed. And then when that starts to calm down, because we get that under control, and no doubt there may be more guidance issued between now and then. And then we have to start getting information together for the filings for existing entities, which, as Alan said, is due January 1, 2025. So I just think it's a lot of advisors are going to be inundated with dealing with this, and some will frankly be overwhelmed. So I think the sooner you start pulling the information together, the better. And I do think that what's going to happen is you, the client, are going to have to coordinate with multiple advisors because not everyone's going to have all the information. I think I agree with Alan. Ideally, if I'm doing an estate plan, I should have the information on every entity that the client owns, but that's just not reality in a lot of cases. All right, let's go on to another topic. Alan, why don't you lead the charge, and let's talk about life insurance and life insurance trusts.
Okay, so under the federal estate tax law, if I die and leave my life insurance payable to Marcia, then
That's his wife, everyone,
that's my wife.
not the
Then,
girlfriend.
right. She has a different name. So then on Marcia's death, the estate tax will be imposed on whatever she did with the life insurance proceeds. Now, if I die first and my life insurance is payable to what we call a credit shelter trust, then it can fill up that trust. It can benefit Marcia for her lifetime, not be subject to estate tax when she dies, but it will have used up part of my exemption and will reduce what's called Marcia's portability allowance. So the third alternative, which is usually the better one for any one estate taxable, is that the life insurance goes into an irrevocable life insurance trust, which we call an ILIT. Marcia can be the trustee of the trust. The trust is held for Marcia's lifetime health, education, maintenance, and support. The trust owns the life insurance policy. If I transfer an existing one into the trust, it has to be in there 3 years before I die, unless you sell it to the trust in a special way. And so when I die, it's not subject to estate tax. It doesn't use any of my portability allowance. And by the way, if I'm sued while I'm living, the creditor cannot touch the life insurance trust. Now, the transfer of money or the policy into the life insurance trust can use up part of my $17,000 per person annual exclusion or my exemption amount. So you look at that as well. But I think that's the brief explanation of what an ILIT is and why there are so many of them out there for very good reason.
Let me just amplify a couple points Alan said. First, insurance trusts, these irrevocable life insurance trusts, are one of the most common estate planning tools. And years ago, they were almost everybody had one because the estate tax exemptions were so much lower that the insurance policy alone would trigger a tax if you didn't have one. With the very high exemptions we have now, maybe there have been less used, but I kind of think that's a mistake because to me, and Alan kind of said it, I like the asset protection and the management of an insurance trust. If there's a young couple, they may go out and buy several $1,000,000 of insurance on each other just because it's inexpensive and they have kids and they want to make sure if something happens, there's money there to pay off the mortgage so that the surviving spouse, has some financial flexibility and so on. Usually the amounts involved in insurance policies are pretty large. I like protecting them from all the things that go bump in night, even if there's not an estate tax. So if anything, I think the high exemptions have lulled some people that should be creating trusts because it's not that big of a deal to do into not doing it. So they really are a very common tool. And part of the goal of this discussion was that I find that they're just not paid enough attention to, and they need to be paid attention to. So, for example, the heart of an insurance trust is the insurance policy. I don't review policies. I don't know if you do, Alan, but I'm not an insurance expert. But I often, I always tell people that they should periodically, at least every 2, 3 years, have the insurance policies reviewed. Sometimes your circumstances change. Sometimes you develop a health issue and you may be able to exercise an option to convert a term policy to permanent. Sometimes your needs change and you need more insurance coverage. You may have made a lot of money and it may be tied up in an illiquid business or real estate. So you may want to change the amount of coverage. Sometimes policies don't perform as anticipated. Sometimes companies fall on hard times. So it's very important to periodically have an insurance expert monitor the policy to make sure it suffices for your needs and that it's performing as you wish. And I'll tell you, so frequently, I'll have a client come back after 20 years of not being in my office. They haven't looked at the policy. They just keep paying the premiums and they assume they bought a policy, it must be fine. Not a safe assumption. not a safe assumption. So get your policies reviewed, get people like even young couples who don't have trust to look at it. You have to, Alan, what about the trust? Should they be reviewed, the trust document? After all, it's irrevocable. Should we ever look at it?
They should absolutely be reviewed. Even if you don't like your life insurance trust, you could buy the policy back out or set up a new replacement life insurance policy, give it money or stock, and then it buys the policy from the old life insurance policy. And then the
Very common.
old life insurance trust. So you should definitely take a look at this thing and balance the rest of your estate plan against it. And the life insurance trust that I set up for Marcia gives her the ability under her last will and testament to redirect how it goes when she dies among our common descendants. And that's called a power of appointment. You want to make sure that that power of appointment is in that life insurance trust if that is consistent with your planning.
So one of the most common things I see, and I'm sure you see it frequently too, is trust done long ago very commonly paid out the assets to the kids once they were some age like 30, right? Because at 30 they should be mature enough to handle money. That is really not anywhere near ideal planning, because what if the kid gets divorced? What if the kid's imprudent? What if the kid gets sued? What do you do about that, Alan?
Well, you can reform that trust so that it benefits each child for their health, education, maintenance, and support for their lifetime. And then creditors can't reach in, divorcing spouses can't reach in. It's estate tax proof. If you do it right, you may have to, if you're converting an existing life insurance policy, you may have to sell the policy to a new one in the way I described. But your points are all really well taken, Marty. All of those things are really important to review. And when we see life insurance trusts, those issues happen time and time again.
All the time.
It's frustrating even for the lawyer to see the hard-earned monies and proceeds from life insurance go immediately down the toilet on the death of a client, because they go directly to a drug addict or directly to a spendthrift or directly to a divorcing spouse or directly to a creditor. We see that time and time again. So very inexpensive, relatively speaking, to get a life insurance trust or replace or change the life insurance trust you have.
What Alan just gave is a great advertisement or education as to why you want to use insurance trusts, even if you're not subject to estate tax. And I think that's a very common mistake now is, gee, my whole estate's only a couple million with the insurance. Why do I need to bother? Well, if you got a $2 million insurance policy, it's worth protecting. And you're buying it because you want to protect the people who are the beneficiaries. The trust is the way to do it. And we commonly see old trusts with all sorts of problems. Why are people waiting 20, 25 years to come back to address it? I think they don't understand that just because you did a trust years ago, that it may be able to be improved. Times have changed, drafting has changed, your circumstances may have changed. And by the way, if you're an insurance consultant or an accountant and you see a client that has an old trust, encourage them to address this, because it's really a huge benefit. It's often not that big of a deal to do. Slide 18, I can just say very quickly, what I find is very few people, and I'm saying this in the context of life insurance trusts, but it applies to all trusts, and probably most entities as well. Few people seem to have the records for a trust that they should have, even the trustees. You want to have organized the actual, an original of the trust if you have it, at least a PDF if you have electronic files, but you should have a complete signed copy of the trust. I can't tell you how many times when somebody comes to us, whether from another lawyer or whatever, and nobody has a complete copy of the trust that's been signed, or they have a complete signed copy, but it's missing 2 pages and no one can find it because it was done 30 years ago. Try to get this stuff organized now. The longer you wait, the harder it is to find old records. If when you did the trust, you had your attorney do a memo, put that in the file. If you had an accountant get you a tax ID number, put that in the file. The projections when the policy was first purchased, maybe some communications, correspondence from the insurance consultant, put that in the file. It may explain why the plan was done, what it is. It may explain some of the assumptions of the plan so that you can look at it and just common sense say, gee, these assumptions have changed. We need to revisit what our coverage is, or the type of policy. So I encourage anyone that's involved with an insurance trust, or frankly any trust, but get all the documents together. Once you have an organized compilation of all the documents electronically, it's very easy to have it backed up. It's very easy to send copies to your other advisors, and do that, because if your attorney, your accountant, your insurance consultant, your wealth advisor all have this simple electronic file, whoever you call to ask a question to has all the relevant information. And years from now, it's only going to be harder to find it. Alan, what about gift tax returns? Making
Well,
gifts to fund insurance?
well, if you're under the $17,000 per year exclusion and you're using what we call the crummy withdrawal powers, you may
You
not.
better explain that.
So I could give my daughter a $17,000 gift. I could set up an irrevocable trust, put $17,000 in, and give my daughter 60 days to withdraw it. If she doesn't withdraw it, then she can't withdraw it, but it's considered to have been a gift made to her for purposes of that annual exclusion. So that's what you commonly do. You commonly put a provision in the life insurance trust that says within 60 days of my contribution of a premium, the following people can withdraw up to $17,000 each pro rata in order to qualify my contributions for the gift tax exclusion, assuming that I already haven't given them that kind of money or assets of that value. The alternative, which Marty points out here and that we definitely need to mention, is the split dollar arrangement, where if I spoke this morning with a client who's putting $500,000 a year into a life insurance trust to pay for a very large policy. I said, what you could do is, like a low interest loan, you put the $500,000 a year into the trust, and when you die, your revocable trust or your family partnership or LLC gets repaid everything you put in there, plus a bit of a time value of money adjustment. And that way you don't have to report it as a gift on the gift tax return. You're not using part of your exclusion, and it just comes back into your estate later, but you come ahead with a time value of money. And for those of you who have these split dollar arrangements, if you've set them up in the last few years, they're probably under what they call the loan regime of the split dollar rules, which means every time you make a payment, you're making a loan, and that loan is normally at the long-term applicable federal rate. That rate is now about 4%, not 2% or 1% anymore. So you may want to switch your split dollar plan. If your client is under age 60, switch it to the equity regime, no longer the loan regime. I'm not going to get into what that means because we could stay another hour, but if you have a split dollar arrangement and you're still making premium payments, you want to look at it. And I'm also going to mention that under the Cahill case, if you have a split dollar agreement that specifically says that it can be amended by the insured and the trustee, you need to get that provision out of that split dollar agreement more than 3 years before your client dies. Marty, I know I took way too much time there. I hope I'm still your friend.
It's fine. But the bottom line take home point is there's complications and twists and turns, not on a lot of islets. A lot of them are pretty plain vanilla, but you got to know what you have and you got to make sure it's being tended to. And I just find that clients and advisors just seem to assume, well, everybody's got an insurance. They're so simple. Some of them are, but they still need, some ongoing administration. Some of them, if you start getting into complex funding and large premiums like Alan just discussed, they need even more ongoing care and attention. And if you don't give it to them, it's just not going to work. Take home point on all this is don't get loosey-goosey about it. Part of the reason you set up an insurance trust to hold insurance is to protect from creditors and claimants. And if the trustee is ignoring provisions of the trust, whether it's a crummy notice or something else, if the trust itself is not being respected by the people involved, why should the creditor be bound to be bound by it? I just had an email from someone today where the trustee has not made mandatory income distributions for years from a trust. Well, again, if the trustee is not respecting the terms of the trust, it's going to be a problem one way or the other. Just quickly, some other steps. Some people use the social security number because it's a grantor trust. I like to have a separate tax ID number. Make sure the insurance company has the right tax ID number. Many of us have pre-funded insurance trusts with more money in case the exemption was going to be reduced or changes in grantor trust rules, which had been talked about in 2020 and 2021. So the traditional historic ILIT insurance trust just had a checking account with $100 in it. You would make a gift of what you needed to pay the premium. The trustee would issue the crummy notice, pay the premium, and that was it. Many ILITs, I won't say most, but many ILITs now have, investment portfolios. You have to pay attention to that and make sure that it works. And the bottom line on the bottom of slide 20, review the plan. Alan, revenue ruling 2023-02. I can't get a basis step up anymore on assets in a grantor trust. Can you explain that succinctly in English and then tell me anything you want to say about it?
Okay, so I establish a trust. It's irrevocable. It's for my descendants. And when I set it up, I put $1 million in it, and I retain the right to replace trust assets with assets of equal value, which causes the trust to be disregarded for income tax purposes. And as a result of that, the income of the trust goes on my income tax return. I pay the tax on that. It's not considered to be a gift to the trust, and it's a lovely, lovely way to do estate tax planning. And in addition, under a revenue ruling from 1985 called Revenue Ruling 85-13, I can sell assets to that trust. And because the trust is disregarded, there's no income tax when I sell assets to the trust. It can pay me a low interest note, so those assets can grow at 8 and 9% and generate income, while it owes me a note at 4%, and the arbitrage is a big difference. And then when I die, if the trust is disregarded, do the assets in the trust get a new income tax basis? And there's two schools of thought on that. One school of thought is, hey, the trust is disregarded. The Internal Revenue Code says if I die, any bequest I make, the asset gets a stepped up value. Well, I die, the trust is disregarded. Did I make the bequest or did the trust make the bequest? Do I get a step up or not? The IRS has really been silent on this for decades. This goes back to the 1980s, 1970s. They've never said much about it. There was one private letter ruling where they gave a step up, but it might have been a mistake. But
I think it was in the foreign context.
Yeah, it was a foreign one. So Senator Sanders and others,
Elizabeth
Warren, have been sending letters to Secretary Yeltsin saying, Yellen, and she was, what are you going to do about this? What are you going to do about this? Well, the IRS issues Revenue Ruling 2023-2 and says, sorry, Charlie, no step up. Well, the fact is, now we know that the IRS's position is that there's no step up, but the IRS doesn't have the authority to change the law here. So in my humble opinion, maybe not so humble and not well respected opinion, there's just as good a chance that you'll get a step up when this finally goes to an appellate court as that you won't get a step up. But it is dicier now that the IRS has come out and that you would have to disclose on your tax return, I'm taking a position contrary to the IRS's position. What are your thoughts, Marty?
Well, it clearly puts the IRS on notice. It's like waving a red flag with shiny bright lights flashing on it. I don't know that I would say that there's just as good of a chance of a court respecting the step up in this position or not. I know that there are practitioners that have taken this position, a meaningful number of them. I know that there's a meaningful number of practitioners that have consistently said this doesn't work and it's not an appropriate position to take. So I'm not going to say that anyone's right or wrong because I don't like to set any standards. I don't want to have a recorded webinar that I do be used as evidence against somebody. So I'm going to just say that you have to proceed with caution, which is obvious because the IRS has said it doesn't work. Whether you've done it before or not done it before or want to consider it now, you need to talk to your tax advisor. Clearly, the risk of such a position is increased because the IRS has now in black and white said it doesn't work. But again, this is one of the many, many, loopholes that some have identified that need to be changed to prevent what is viewed by some as unfair advantage to wealthy people trying to plan their estates and their income taxes. So it's very important to keep in mind, take a look at it and see. Now, the Calico case, changing gears again, to me is really, it's what happened was that a marital trust was set up, commonly used in estate planning. Marital trust, a qualified terminable interest, or QTIP, if you see on the screen, requires that income be paid out to the surviving spouse at least annually. And many will say quarter annually. Some will just say annually, but the income has to be paid out. In this particular case, the income was not paid out, and there was an underpayment for years of the QTIP income. That would have concerned me as the trustee because, gee, if I'm not paying the income out, does that destroy the QTIP treatment so that the marital deduction in the estate of the first spouse to die could be jeopardized? I don't know how that gets played out, but that would concern me, not adhering to the terms of the trust. Alan, any thoughts on that? What happens?
Yeah, you have to adhere to the terms of a trust.
Right. And what happens if you don't?
Happen.
Do they go back? Bad things should happen, but I don't know if they can actually go back if the tax year is closed for the estate and disallow the marital deduction. But the whole thing would really concern me. No, I don't think any advisor anywhere would say intentionally ignore the terms of a trust.
I agree. And, family members say, well, this is what dad wanted, but we're going to do it our way. No one's going to complain. Don't worry about it. Let's ignore what the trust agreement says. And then you get a bratty grandchild when they turn age 18. They sue the living daylights out of everyone that they can see and find so that they can get more drug money. And, we see this happen in family situations. So follow what the trust says or get a court reformation. Don't ignore these trusts. I think that's the most important lesson of Calico. I think you're muted, Marty.
Sorry about that. Let's go on. So in this case, the numbers are really big, and there was, in fact, a lawsuit. So what happened is a settlement was reached, and the settlement was paid, and interest was paid on it, and then they wanted to treat the payment as a deduction, and the IRS said no. And the court agreed, and it was not upheld. So I guess lesson number one from this is you're not going to get a deduction in this kind of context for the settlement payment. The main lesson is you got to adhere to the terms of a trust. And this is why I always encourage people that have trust to make sure that they have an annual review meeting with their advisors and make sure they're adhering to the terms of the trust. If you sit down with your attorney, your accountant, whatever, your wealth advisor, and preferably all the above, and you have a discussion about the terms of the trust, somebody's going to read the trust and say, hey, you got to pay income or you can't pay income, whatever it is appropriate for the trust. You want to adhere to it. You don't want to get into these kind of problems. The other issue, which is more significant to me, and we're not going to belabor it, but I think it's just another one of the myriad of lessons like this that we see all the time, Alan, is the negative consequences of family disharmony. This estate plan had kids from a different marriage, grandkids suing, everybody suing. It went on for 10 years. 10 years. Can you imagine the cost in terms of family angst that a 10-year lawsuit of this magnitude created? Can you imagine the legal fees on both sides? Clearly, this big extended family is not getting together at the same table for Thanksgiving dinner. It's tragic. I think it's really important, and this to me is the key sort of message of the case. Try to get plans coordinated. Try to think through the what ifs. Get your advisors involved. Try to think through how things can go wrong and try to plan to mitigate those problems. when you have this level of a family dispute, the only one that wins in this case are the litigators. The estate planners don't win, the family doesn't win, the trustees don't win. It's an awful, awful experience. And I just wish more people would spend the time talking to their advisors, not just say, this is what I want to do. How will this is what I'm thinking of doing. How will it play out? What can we do to shore it up so there's less chance of a fight? That needs to be front and center in a lot of planning, especially when there's a blended family. Alan, any thoughts on that?
No, you said it wonderfully.
Yeah, it's just no estate planner, no estate planner ever likes to see these kind of things happen. It's awful. It's awful. And I just wish more clients would let us work and maintain the plan so that if we get an inkling that something's coming up or could come up, maybe we can deal with it. Because don't forget, when you go to an estate planner and we've just met you as a client, nobody can foresee all the issues. That's why it's good to involve an accountant who's been representing the family for 20 or 30 years. They may have insights into the family dynamics that an estate planner may not realize. And when things change, because they often change, that's why it's important to have a pattern of going back for review. Do you want to talk about the Green Book for just a couple minutes? I don't know that it's worth too much more than that right now.
No, I mean, yes, sure. What do you want to say?
Oh, you don't want to talk about it?
It's
I mean,
scary
I
to
think,
it's
go
scary to
on.
think about, because what I will say is it shows that the Biden administration understands what we're doing and wants to stop
Planners.
some of our best techniques. They understand these installment sales to defective grantor trusts. They understand these discounts. They understand a lot of these estate tax planning techniques that are not well known to John Q. public. They have our number. So the question is, are they going to have enough votes to do away with this planning? The other question is, I'm a big believer of survival of the fittest. And you see these wealthy families and they're not doing any planning.
I don't
And they
understand that.
won't be around. They won't be around after these laws change and it's too late to take the life raft out. It's it's very interesting to watch that, isn't it, Marty?
I see it all the time. I had a conversation with a new client. It's like a $50 million net worth client. And he thought about everything we talked about and says, I want to hire you, but what I want to do right now is just develop a plan. I don't want to do anything. But if we have a plan, then we'll think about it. I said, you can do anything you want. I'm happy to just have a meeting and put together a memo and help you develop a plan. But I think you're making a terrible mistake. There is simply no way to predict when things will change. And oh, by the way, usually if you're doing good planning, there's asset protection benefits, there's divorce protection benefits. I mean, why not just do it? These kind of proposals by Bernie Sanders, Von Hollen, et cetera, these have been floated for years and years. I think Bernie Sanders, Senator Sanders is proposing similar changes, some of them similar, for more than a decade now. One day, a lot of these things may just get enacted. It may not be now, it may not be in 2024, it's going to happen. But why on earth wait to see if it happens? And by the way, what Alan was talking about with the recent revenue ruling, the senators, I don't know, petitioned is a fair word, pressured, encouraged Treasury Secretary Yellen to try to encourage the IRS to try to issue rulings to change some of this. Some of this may come from the legislative side. Alan, remember the 2704 was it B regs some years ago that would have almost eliminated discounts except for active operating companies, and it really would have put a dent in a lot of the planning people do. I mean, some of this stuff may come through a legislative avenue. And like I said earlier, we have no idea what kind of deals may be made when the various people in Washington are negotiating on the debt ceiling. Maybe some of this stuff gets thrown in the mix as part of a deal. You don't know. What was it? The pothole bill, as we affectionately called it, that brought us basis consistency reporting. I mean, that was just a crazy highway bill that they patched, no pun intended, patched onto it some provisions that dealt with estate consistency and reporting that are incredibly complicated. So anything can happen. Don't wait. Don't wait. As Alan said, this stuff could unravel future use of many of the techniques that most estate planners use. I
Right.
think insurance and charity are okay, but I'm not sure if much else is. Not even all charity.
Well, especially the ability to sell assets to a disregarded trust in exchange for a low interest note. Interest rates are going up, and that's based on a revenue ruling. So they could reverse the ability to make these sales. So definitely be on your toes for the wealthy clients.
And by the way, let me just caveat wealthy. Even if you're under the exemption, keep in mind it's getting cut in half in 2026. If you're 50 years old and still growing your estate and still investing and still doing business, and you're at a $10 million level, just project that forward at a 6% rate of growth. And you're probably doing better if you're involved in a closely held business. You're going to end up with a pretty large taxable estate at some point. Why wait? And if you get good asset protection in the interim, what's the downside? Let me tackle the next topic because I think we're approaching the end of our hour. This is something that I just see off radar all the time, and it really needs a little more attention. And it's not in the swim lane of any particular advisor. And what am I talking about? Agent confusion. There are so many different things that we can do that put different people in power of different aspects of our life. The common thing you'd think of is, oh, I'm going to sign a power of attorney. I go to a smart estate planner like Alan. I say, I need a power of attorney. You know, I'm 66 years old and I got to have a power of attorney. Name my wife, name my kid, name this, name that, do it. He does a power of attorney. That's fine. But is that the only document? Maybe if I'm thinking a little broader, which I encourage all of you to do, I'll do a revocable trust as well, and I'll actually put assets in it, not just keep it as a standby. Is there coordination between who the trustee is and who the agent are? If they're different, is it intentional? But that's just the starting point. People name, I have a client I met with this morning, a new client. Every account they have is joint POD, pay on death, TOD, transfer on death, with different mixtures of kids. There's just no way each of those kids is going to coordinate with the siblings they named as agents under their power of attorney. You got to have coordination. Who's going to be in charge? And if my agent is named, if I name my wife under my power of attorney, but I got kids or a friend like Alan under, as a co-owner on accounts or as a TOD or POD on an account, who's going to be responsible? For long-term care insurance, because of the lapse rate on long-term care policy, long-term care companies have to have you designate someone to get a lapse notice. Is that the same person as your agent? Is it somebody else? And one of the things, and you see a whole list here, and there's even more that could come up. Social Security, funeral agent. You may have a post, a physician order for life-sustaining treatment. That's medical. But are all these things coordinated? Do you have track of them? And what happens when you name different people in charge of different positions, and then a decade goes by and you're not even talking to these people? If I go back and meet with Alan as my estate planner, he's going to update my power and health proxy and living will, but not all these other things necessarily. Alan, any comments or thoughts?
What is the recommendation, Marty? You keep a chart of all these people and check it every year or two, make sure that they'll all have access to what they'll need. And who gets the
I think
password to my Facebook account?
the point is you got to start looking at all this stuff. And that's another good point. If you don't have the right credentials, the agent under the power of attorney, how are they going to get into your account? If you have a temporary disability and you're hospitalized for 4 months, it may take longer than that for them to find out the passwords to get into your bank account online. So there's a lot of practical implications. And I think one of the take-home points is it's not just about the sexy estate tax savings. It's not just about the fancy trust, I got a non-reciprocal spousal lifetime access trust in Alaska, and I can tell everyone when I'm going golfing with them about this cool trust I have. And it's a non-grantor trust, so I can use SLANT as the acronym instead of SLAT, so it even sounds more intriguing. You got to look at a lot of these basic fundamentals, because if you get sick or if you have an issue, these little details make a huge, huge difference. And this slide will help get you going and get you started on it. Community property. Alan, do you want to just make a few comments on that? And then I think we're getting close to wrapping up, because the rest we can go through pretty quickly.
So if you live in California, Texas, Nevada, Arizona, or Wisconsin, one of the other community property states, what you have accumulated during the marriage is called a community property. It doesn't matter which spouse owns it. On the first death, you get a new income tax basis. which is a good thing. But if one of you gets sued, you lose everything, which is a
Not a
bad,
good thing. Not a good thing.
not a good thing. So you move to Florida or you move to New Jersey, you're now not living in a community property state, but your community property is still community property. So do you transmute out of it? Do you want to stay in it? It makes big differences as to how you handle it. If it is community property, then on death, half of it still belongs to the surviving spouse. So you just have to really understand it. Plus, you could set up what's called a community property trust in a state like Alaska or Florida and put your
Tennessee,
asset in it,
South Dakota.
South Dakota, Kentucky, and then on the first death, you could get a new income tax basis. So the planner has a lot of things to think about nowadays, especially as many people who are actually leaving California, fleeing those higher taxes and leaving Texas. Very, very complicated, but interesting area. Don't forget that it exists.
I think just to highlight one of the points Alan made, if you lived in a community property state, married, and then you moved out, it may be off everybody's radar. If you're the client, you got to make sure your attorneys, your tax advisors all know, yes, we were living in Arizona. We may have community property. I don't understand what it is, but we were living in a community property state. Make sure they know it. Let me just make a couple of comments, and Alan, comment on, jump in. One, I have a client with community property. They have stock that's community property. Husband wants to put that stock in a spousal lifetime access trust for wife. I said to the attorney in the state that's doing the transmutation agreement to make it non-community property, he wants to just transmute it from community property to husband's name, and husband's going to make a gift. I said, I don't think so. What I think you want to do is transmute it, which means it's going to go 50-50 to husband and wife because it's community. I said, you better wait at least a couple of months. I'd prefer longer, but at least a couple of months, because if husband is going to make gifts, did that have a taint to the wife's interest in it? Now, the attorney there says, I don't really agree with you. I don't think that a step transaction doctrine risk or issue could apply to severed community property. I don't know, but I'd rather be careful if we can. Next, they actually want to give all the stock to that trust. I said, well, what I would do is sever it. I'd wait at least 30 days, 60 if you can, maybe more. Have wife gift assets to husband. Have husband then wait another several months minimum and do some stuff with the assets in the meantime if he can. New shareholders agreement, a dividend distribution before he makes a gift, because I think that's another layer potentially of step transaction issue. So when you're dealing with community property, it's not only the step up and who gets it, but lots of issues. Last quick point. If husband and wife take community property and divide it, and then husband puts the community property assets after waiting at least several months, and there's no fine line, maybe 6 months is better, maybe 30 days is enough. I'm not commenting, I'm just making a suggestion. If you can, 60 days is what I would hope would be a minimum. If you can't, don't always have the time. But if the husband then makes a gift to a spousal lifetime access trust that the wife's a beneficiary of, think of what happens if there's a divorce. So if it was $100 that came out, wife now owns 50. It used to be 100 of community, which means each half. She now owns 50. He set up a trust for her with 50. So she's really kind of got all the money and he's got nothing out of it. So just keep in mind what all this means is, just sort of echoing Alan's point, there's lots of twists and turns and complications with community property. Alan, why don't you make any kind of summation, closing comments you would like?
Marty, you do a wonderful job with your newsletter. So conscientious on looking at all of this. Letting me participate in these webinars is something I really appreciate. I look forward to. I always learn a lot, and I always enjoy it.
And I always appreciate that you have a different view of everything than me. But by the way, everyone, that's important, and that's why I like speaking with Alan. If it's like an old joke. If you put 3 estate planners on a desert island and ask them a tax question, you get 5 answers, right? There's a lot of different views on things. And so much of what we do is not only uncertain, but it's so fact sensitive. You want to be careful. And hopefully some of the take home points are even a simple, common, ubiquitous planning tool like an insurance trust pay some attention to it. Give it a little love and care, because there's lots of interesting issues that come up even on simple trusts. Get ready for the Corporate Transparency Act. It's coming, and it's going to be a pain in the neck, and there's severe penalties. And take a look at all those different little agent appointments, even the things that seem trite and sort of off radar, because they may come back and make grief, if not for you, for your heirs, and you want to try to address it. Thank you, Alan, for participating. It was fun. We'll do the next one together too. And thank you, everyone, for joining. And please keep in mind, all these comments are for educational purposes only. I should say entertainment too, shouldn't I?
I think entertainment, yes.
What could be more entertaining than talking about grantor trusts? Take care,
Exactly.
everybody.
Right. Take care.